As business owners, it's easy to focus on the finances of our business, but often we overlook the finances of our personal life. Well, today, I'm joined by Geoff Sokol, our private wealth advisor at GT Investment Management. Geoff, welcome to the show.
Thank you, Tim. And that is a great intro. What we would like to do here is try and bridge that gap between what's going on at the business and what might be going on the personal side. Before we jump in, it's always important to say we're going to discuss some broad market and investment themes. If you hear anything and think, oh, I got to do that right now, pump the brakes. Make sure you are speaking with your financial advisor, and it's a personalized conversation, because nothing in this video is going to be a personalized investment opinion or advice for you specifically.
So, there's some critical mistakes that occur as business owners. I've been a longtime business owner myself, and I can tell you firsthand, it's easy for me to jump into the P&L of my business and see what's going right, going wrong, and try to make adjustments from there. And when it comes to my own personal finances, I often put them off in lieu of just focusing on the business. And it's not really till the end of the year where I start asking bigger questions of like, man, should I have spent a little more time working with my wealth advisor and kind of going through my personal financial plan? I feel like I'm not alone in this. Can you tell us a little bit about some of the mistakes that you see other business owners make in this arena?
First of all, you're certainly not alone in feeling that way. I've done it myself. I have a background in business development, and when you're doing this, it's everything is day to day, week to week, month to month, and you have revenue targets. If you miss, then it can be catastrophic. So a wealth advisor who's saying, hey, let's zoom out. Let's look at the next few years. Let's look at the next few decades. And you're thinking, I don't even know what's going on in the next few days. I don't have time for this. So it happens. And it's an easy trap to fall into. So what I would say is you don't have to carve out hours and hours, but an hour here or there on a monthly basis, or at least once at the start of a quarter, start to do some planning. So that's what I would say is the first mistake. And we can start with a good one that at the end of the year, the fiscal year wraps up and you hand over all your paperwork to the accountant. And it's like, okay, save me on my taxes. And I'm sure the accountant says, this would have been a lot easier if we had done this about a year ago. So the first thing would be a failure to plan. And like you mentioned, like I mentioned, it's easy to get caught up and avoid doing this, but I can make it real with an example. A case I'm working on for a manufacturing company. They're doing wonderfully well. It's a classic thing where they've been able to increase their revenues. They're just breaking past all their thresholds. They're stuck at a few million, then they double, then they triple it, they quadruple it. Everything seems like it's going well. The profit margin's expanding too, and it's like they're walking on sunshine. They're on cloud nine. So a colleague and I dig into it when they're thinking about selling their business. Their valuation has increased so much, it makes sense to cash in on it. And we can see that they've filed their Schedule K incorrectly for their partnership since 2019.
Wow.
And now it's like, you've done all this stuff so well that you could sell this business at a multiple of 5 or 6 or 7 or 8 times the annual revenues, which is phenomenal for that industry. But you're looking at maybe only getting 50 or 60 pennies on the dollar because of this mistake you made, because you're doing everything so well. It's like, hey, who cares? We have enough money. We'll pay the tax man later. It's like, It just doesn't work that way.
Yeah, paying the tax man later is pretty common for a lot of small business owners. And,
Sure.
the large amount of business owners in America are small business owners. They're family owned and operated. And, the conversation of how's business going sometimes is scary because entrepreneurs are riding this emotional roller coaster. And even in a situation where a business like the example that you gave, where they're doubling and then tripling and then quadrupling, in most cases, business owners have never experienced that before. So they're riding this wave, but most entrepreneurs, if we're being honest, are going to experience a wave like that maybe once in their lifetime. And they don't even know how to handle growth, because it's not always the crisis. Sometimes it's the growth that we also don't know how to handle. What's your advice for someone who's starting to see this rapid growth as it relates to their private wealth management, their personal wealth?
Sure. We see this a lot, not necessarily the growth story, but in general, you start making these calls when something happens. And I know you've spoken about this with Jeff Jones, with Eddie Clay, with some of our other colleagues. It's like, you don't need something until you do, and then it becomes the only thing that you need.
Right.
So it's like this muscle that you want to develop where, you know, things could be going well, things could be going poorly. You could be accelerating growth, you could be decelerating growth. Just have these things, have these items on the calendar that, you know, the second Tuesday of every month, you meet with your advisory team and everyone gets 10 or 15 minutes to chat, see where they're at. And it just makes sure everyone stays on the same page. And, you know, we don't always, in the advisory business, we don't always hit home runs, but it's like this, we can figure out a way to unlock some value in these little areas. And I like to give this example where the math on this is pretty phenomenal, where if you get 1% better every day for 365 days, then you'll be 37 times better than where you started. So
I,
it doesn't feel like you're hitting this grand slam, you know, this walk off home run all the time, but it's like we make the right decisions every time and it starts to compound on itself, and then before you know it, you know, it felt like we only saved a couple thousand here, a couple bucks here, we did like 1% better here, but then you look back a couple years later and you're like, thank goodness I did that and developed that muscle to have all those meetings, because you know I wouldn't have gotten here without that.
yeah, let's talk about this. You touched upon a pretty interesting subject here. The planning is important, of course, but planning for growth. I think a lot of times as business owners, we're kind of naturally built to plan for the decline, right? Because we're always
Sure.
expecting the decline. The economy's tough, labor laws are tough, working with clients and customers and vendors, it's tough. So we're always kind of ready for when things fall apart, but we're rarely ready for when things exponentially scale. And that's what I think we're
Sure.
talking about here is the exponential scale of our business. And when that does occur from the private wealth management side, what would you invest in? What would you do, practically speaking, if you were, let's say, paying yourself, two, $300,000 as a small business owner, and you had your distributions at the end, and all of a sudden you had a windfall, and it looks like you're going to be sitting on an extra $1 million in cash by the end of the year. Where does that money go? How do we shelter it? What are the best investment strategies? What's practical?
Yeah, it's a great question. And it's a good problem to have, I would say. But also, yeah, it can be intimidating. You know, if you don't have that plan, then the moment comes and you don't know what to do, and then the moment passes you by, and then you know you're hoping it happens again, and it may not. So this is where the family office piece becomes important, because there are these big box type advisories, and it's a term we use in the business when we say big box. What we mean is they're going to size you up. It's going to be like, okay, he's, you know, he or she is 40 years old, married, has a couple of kids, has this much money. Strategy A works for this person. And it's like very detached.
Mhm.
Um, it's like you go to a doctor and they look at your height and weight and they say, okay, your BMI is this, therefore you're overweight. But you're like, hey, I'm crushing it. I'm in the gym all the time. I have low body fat. I'm not overweight. It's like, because you're just looking at these superficial factors, it's hard to really dig underneath the surface and find out. So how does that relate to the family office? Well, we're not just going to advise the business and we're not just going to advise the person, but it's the families of these people who are involved. So we can figure out where this person's at, and then what value we may be able to extract from the business, and then what to do with it. And that's where it comes into play. If you have kids that are 10 and 15, for example, and you're behind on their education savings, then, you know, maybe the next 3 5 years we want to try and figure out a moderately aggressive growth strategy to be able to afford 4 year tuition for those kids, and maybe that's the top priority right here and now, and then you would invest accordingly. And you know, you're never putting all your eggs in one basket, but you can dig into what's going on with the variables at the family level to figure out what strategies make the most sense. In that case, it could be education savings. In my case, you know, having a couple of kids on the way, we got to start, my wife and I need to start setting some money aside for that. We have family that live in another country. So having someone who can tell you, in order to get money abroad, you know, here's a strategy that works to get the money there and shelter it from taxes. And, you know, being able to go into those much deeper and more meaningful layers and conversations is such a way to put the mind at ease and eliminate all these extra stress factors.
Yeah, it's a good point about uh, looking at the comprehensive person and not just the business on its own and not just the person on their own, because people run businesses and a lot of times the finances are closely connected. But let's
Sure.
talk about when finances are too closely connected and there's some trouble when it comes to unwinding those personal finances and making sure that there really is a true separation. I've seen some businesses that are wildly successful operating for sometimes a decade plus, and there's still a lot of commingling of dollars, the personal and the finance, still inside of the business. And then when a situation comes where someone wants to sell, oh my goodness, now we have to spend all this time, pulling out the spreadsheets and the P&Ls and the bank accounts, and it takes a lot of time. So what's your advice and guidance to a person that's currently doing that right now?
Yeah, it's funny because you'll hear a lot of tropes in this line of work where it's like you have to separate personal and professional, and that's good advice. And then here I come to say, well, we want to bridge the gap between personal and professional. It's like, which one is it? Um, what you want to do is have clear categories. So it's like if we're doing professional financial planning, let's start with the balance sheet and then let's get into the income statement and let's figure out, our assets and our liabilities on the balance sheet side, our income and expense on the cash flow side, and then let's start to plan that side of things. And then now let's do that on the personal side. And then you have a clear level of separation and you can create a professional business financial plan on the one side and a personal financial plan on the other side. And then you bring the bridge in to figure out at what time zones or when is it going to make sense to extract some of the value from our enterprise. And then once we've done that and we've created a clear transaction and the books are neat and tidy, then let's get that money over to the personal side where we already have a plan and we know how we're going to put that cash to work. And then you have everything separate, neat and tidy, and then you're leveraging one to assist with the other.
Yeah, no, that's a good point. And what I've noticed over the years in my own personal life and in my professional life is the more I understand about personal finances, the more it really helps me understand the personal finances of my team and my employees and what I'm trying to do for them because I'm going through that stuff myself, right? So I'm understanding about putting money away and setting up various funds and doing various tax shelters. And then I look at my employees, and as the business starts to become more and more successful and we start to scale and grow, then I'm actually a little wiser as a business owner, as an entrepreneur, to holistically help my team so we can then become more and more and more successful.
Absolutely. And, when you come from an investment banking background and you're so accustomed to spending time looking at charts, reading research reports, and then plugging these models into an Excel sheet, we feel really excited when we can say the benchmark did about 7% and I did 10%. And you feel on top of the world because you did this phenomenal thing. And then you go out and start telling people, and they're like, what are you talking about?
Right.
It doesn't have any impact because it's so impersonal and numbers on a spreadsheet, as much as it might excite some of us weirdos, it doesn't have that same effect for from the personal side. And as a manager, when you're trying to build a positive culture and provide value to your staff, so that ability to make everything feel very personal and be attached to a specific personal goal, I think I like to use tuition as an example for children to be able to say, this money that I've been able to get as part of achieving my bonus is now going toward affording this goal that's going to allow my son or my daughter to pursue their goals, and then they're going to be able to achieve generational wealth that they'll hand down for another generation. It's like it means so much more than saying 10% versus 7% because you're quantifying it in a way that is going to have such a positive impact for this person's family and that family into that community. And then it's just going to keep rippling outward from there.
Yeah, it goes back to the business is personal idea. And a lot of business owners, uh, there's a lot of great business owners out there that sincerely care about their teams. Maybe contrary to various opinion in the media, not all business owners are bad. Some business owners, many of them that I've spoken with over these many years, they're looking out for their team. They want the best for them. They want to make sure that these kids do have college tuition and that the funds are put away for rainy days and things of that nature. And plenty of business owners, when they get to the end of the year and they're looking at this mound of cash, of profit that they would potentially, uh, bonus out to themselves or use for distributions or what have you, they would be willing to let the money ride into future investments because you mentioned the 7 to 10%, you feel high on the horse for getting these various returns. But a business owner could look at that money and say, if I reinvested, I could get 100%. I could get
Absolutely.
200% if I just dump it back into ads or hiring more team, making
Hmm.
investments. Is that the objective for kind of tying the two in? So you're not leaving, just focusing on the personal finance, you're also bringing in the business picture?
Yes, absolutely. It gets into some complexity where I think this is helpful working with a firm like ours, where we have our virtual family office, we have investment banking arm, we have our strategic consulting side of things. We're constantly involved in different segments of the market, so we have a really keen insight into the economic cycle and where we are. If more businesses are saving, if more businesses are investing, if now is a really hot time to get into a certain investment class or a certain asset class, we're not guessing. We're going to be able to say, with that amount of money for bonuses or distributions or what have you, we can come up with a specific plan as to where we can invest that capital. And we can look at historical trends for this business of what return they can expect on their invested capital, what return on equity. And, this is where we get into our fundamental analysis. And we can project that out to what impacts it's going to have in the next 1 year or next quarter, or if you want to do more short term versus long term. So
Yeah.
yes, this is the importance, again, to highlight maybe about halfway through the year, where we have an understanding of being able to provide forward guidance about how much money we can expect and how much revenue and what our net profit margin on that revenue is going to be. Now it's time to start planning. And then as we get closer to that time, we're not surprised, not, wow, this is much more and much less money than we anticipated. We have a specific plan as to what we're going to do to allocate that capital accordingly.
Yeah. And there's a dark side to this, which is not planning and not saving and having nothing when the rainy day does come. What are some of the other, pitfalls that you've seen? I know we talked about the lack of planning. I mean, fail to plan, fail, that whole thing. What are other pitfalls? Like what are other big common pitfalls that you've seen?
Well, we've got to talk about the concept of protection, and I don't know what happened, or somewhere along the way, some type of sleazy salesman type of approach got into the insurance industry, where I could be sitting down with someone who I've known for 10 years, and we'll start, getting into it and figuring out what we can do, and I'll start talking about insurance, and they'll be like, "Geoff, no way, you're not trying to sell me life insurance right now." And I'm like, well, first of all, hold on. What are you coming at me for? I'm just asking questions, and it's strange because they're very misunderstood. And I would compare it to someone who feels really financially responsible, who will proudly tell me, "I never use a credit card." And I think, hey, good for you, but I've got a 3% grocery cashback card that I pay my groceries. I never use it other than for that purpose. I I wire the money from my checking account to pay it off before I'm even back home. So I never incur any credit card debt, and I get 3% cash back at the end of the year. It could be like, 400, $500. It's not nothing.
Sure.
Um, and it's like with insurance, it's the same way, where they're like, "I'm not planning on dying, so why would I need that?" It's like, well, first of all, sure, no one's planning on the worst case scenario unfolding, but make sure you have an understanding of what the product is and what it does. For example, I'll just highlight this one because it's pretty exciting, and it's maybe some people may not know, but there's a very variable universal life insurance policy where you get to invest the premiums that you're putting in on this monthly basis. So one of the criticisms with like an auto insurance policy, for example, is I'm paying $500 per month for 4 years, and I never crash the car. I don't get any of that money back. That's frustrating.
Mhm.
With cash value insurance products, you get to invest that money, and then it grows tax deferred, and you can pull it out tax deferred. It's what's called a living benefit. So you could invest, let's say you put 10,000 bucks in for 30 years into this variable universal life policy, and let's say you get a compound annual growth rate of 7%. The math on that is in 30 years, it's going to be worth about $1 million, $1,020,000 that you can then 1035, which in real estate, people may know you can do a 1031 exchange, a like kind exchange from one piece of property to another. You can do that with an insurance policy, 1035 it into something like an annuity that gives you lifetime income, and you can supplement your retirement expense. So I would just say, things are going well in your business. You need to create these ways of protecting the assets.
Yes.
Variable universal life is a life insurance policy. Maybe that doesn't have the same benefit for a business, but to be able to have a business liability, or let's say, 3 or 5 founders are working together, but you're doing really well. Maybe this guy is going to start getting poached. There's another firm that wants to hire him. Then you could take out what's called a key man or key woman policy for this person that protects against something happening. So it's not just death or the unthinkable, but if something unexpected were to happen, you want to have these protections in place so that you know the assets don't start getting drained as a way of coping with the loss of a person, or what have you. So being underinsured is a big one, and I would say the theme is that we have a tendency, maybe it's a flaw with human psychology or whatever it may be, but when things are going well, it feels like they'll go well for forever and ever, and then vice versa, where when things are going poorly, it feels like they'll never get better. So when things are going well is, and Jeff Jones talked about this, that's a good time to start thinking about selling. Not
Mhm.
that you have to sell, but the more you know, and the more options you have, the position of strength may be attractive. So it's another one where you have to have a good consultant and someone you like and trust, who's not going to give you this sleazy sales pitch and cash in a sweet commission, but someone who can tell you, these are the policies I recommend. Here's how we get paid on it, just so that all the cards are on the table. And yeah, making sure that as you start to generate assets, there's a protection system in place is a very important thing.
Yeah, that's a great point. I always say a dollar saved is a dollar earned, right?
Sure,
And when these big crises occur, and it could be a lawsuit, it could be an insurance thing that you wish you had more policy on.
sure,
Uh, they could take millions of dollars. I mean, forget the emotional aspect. I mean, it just drains and drains. It could take days and sometimes months and maybe even a year or two to get out of these situations. But the financial aspect is critical. So you're right. It is beyond just planning. It's planning and then doing something about the plan and taking the action and getting the policies, seeking the information, working with a smart person like yourself, an advisor, a counselor, someone who can just push you in the right direction, has your best intentions. What other ones? We're at two. Is there a third hot mistake here that you see, a common pitfall?
well, I would, pulling on the last concept about saying when things are going well, it feels like they're going to go well for forever. I can speak some from my own personal experience. I've done it twice now, where I was sitting on a massive capital gain, and I didn't do anything about it because, hey, this thing's going up, it's going to keep going up forever. I it's a funny thing. I got into Bitcoin and cryptocurrency in 2014, if you can imagine that. And
Wow.
I've had some opportunity there to take some off the table because I was in some of these like a crypto project, whatever these things are. They have no cash flow, and I work in the business. Of all people, I should have been known to take some off the table, but I was a younger man at the time, and I saw some large balances go all the way up and come all the way back down. So, um, you know, being able to take some off when it makes sense to do so. And another example. So I was over in Southeast Asia. We had grown an education and technology company from one location to 130 locations within 5 years. And the demand was just off the charts. The way that the parents are willing to spend on education for their children it's inspiring, and it's wonderful. And we got to 130 centers. We could have sold for probably something like 10 times earnings, plus factoring in that we were going to keep opening centers. So without getting into too many of the details, let's just say there's a good amount of money on the table there. And then wouldn't you know it, there's not as much demand for going to a learning center when you're locked down in your house during COVID. And it's
Right.
like right then and there, from one day to the next, it's worth this, like Scrooge McDuck diving into the gold coins amount of money, and then it just evaporates. So understanding that taking some money off the table and extracting the value when it makes sense to do so, there's it almost feels like there's like I don't want to use the word shame, but something where it's like, I bet on myself. I'm an entrepreneur. I did this. Everyone told me I was crazy. Now I made it. And you want me to sell? Like,
Right.
get out of here. I'm hanging on to this thing for the rest of my life. And it's like, it's admirable. And everything we know about entrepreneurship is you have to bet on yourself. Sometimes, the odds are all stacked against you and you make it happen. It's like, this is when it is really important that you have these intimate relationships with an advisory team who has your best interests, who can not force you, but can let you know, hey, if we decide to do this right now, here's a way to do it. You maintain majority ownership, but let's secure some of this wealth to be able to take some risk off the table, and then let's diversify it. You're still the owner, you're still the operator, but let's make sure we realize this gain while we can before this exogenous event or this black swan or whatever it is. It's like we think we'll be doing fine unless it's nuclear war. But
Right.
hey, COVID,
Yeah.
that was really out of left field.
Yeah, timing. Timing is everything. We always say the 5 Ds: death, divorce, disease, dysfunction, and distance. The reasons why people are forced into selling their business or getting out of their business. It's best if your business is on an upward trajectory and you can realize it, see the timing for what it is, make some kind of decisions based upon that, whether it's reinvesting your capital into the business or diversifying your funds, taking chips off the table. One
Mm-hmm.
thing is certain is, timing is a very abstract concept, really, when it comes down to it, because there's nothing telling you you must do this now, right? It's kind of like your crypto example, and we've all seen, kind of the wave of that, and we don't have the crystal ball. So knowing that we don't have a crystal ball, how do we make timing work to our benefit?
I think what this really comes down to, and I almost feel like it's cliche at this point, but it's about planning.
Mhm.
And I would use, to make it feel like a real life example, 2022, really good example. I saw a lot of people make mistakes, and hindsight may be 2020, but the idea that there was going to be a recession, it wasn't even consensus. It was like 100 out of 100 analysts on Wall Street say it's 2023, prepare for recession. Is it going to be a hard landing or a harder landing? It's like,
Right.
it was definitely going to be a recession. So what do you do? Well, risk-free rate of return in the treasury market is about 5.25%. So let's get out of equities here and let's get this quote unquote risk-free money. And this is an issue with the wealth management industry as a whole. Is it's become such a thing to be able to say, it's like this point of pride to say we can preserve your principal. We didn't lose you any money. And it's like the goal is maintaining money as opposed to earning money. And so by not having a clearly defined goal, they got out of equities and then they're sitting in this risk-free return, earning 5%, which, 5% is better than zero. But the NASDAQ was up 30% the next year. And then, we're now at all-time highs. We're at like 5,600, 5,700 or so on the S&P 500 now. We're at about 4,600 or 4,800 or so at the highs from 2021. So the idea that you would get out of equity, and it's like the question that should have been asked is, okay, so you're taking this money out of the market. What are you going to do with it? What is the purpose? Let's say, okay, so there's a recession, we lose another 10 or 20%, but then what? It's like the transaction is a taxable event, so you might have to pay some gains. It might tie up some capital, which is inconvenient. And then there's inflation, so you might be earning 5%, but that return is not even keeping up with the rate of the increased cost of living. And now you have this money, but what are you doing with it?
Yeah.
Whereas if I could have said, let's stay invested here, we can find a way to diversify or protect against downside, but we have upside risk too. And upside risk is maybe a lesser discussed topic, but if you're not participating in the upside realized gain, then your emphasis on downside is perhaps not allowing you to see the forest through the trees. Whereas if you have this specific plan and you have a generalized mathematical model for the equity rate of return, then you're not going to make this impulse decision like, I got to get out now. And then, you end up paying the price for it down the line.
Yeah. So to recap a little bit here, and that was a great riff. We want to plan. It kind of comes back full circle to plan, because we have a good plan that we know what to plan for when. things are going down or when things are going up and where money's going to go. On top of planning, we want to make sure that we are not just looking at the individual, but we're looking at the individual and the business kind of holistically, comprehensively. We want to make sure that we're protected and we have our appropriate insurances in place and policies and things of that nature, because why not? Want to make money work for us, right? Because there's some policies out there that can actually work for our benefit. And it all kind of comes back to knowing timing and trying to predict timing. And the best way to predict timing is to just have a good plan, because you don't really have to predict timing because you know what you're going to do in various circumstances. Am I missing anything?
That's a great summary. We could dive deeper into some of the details of some of those items, but I think you're right there. The emphasis on planning it makes things easier. It helps you sleep at night. You don't have these moments of irrational impulse or emotion that distract you from what you're trying to accomplish in a longer term. And yeah, you know, once the plan is on the table, the other maybe the hidden benefit of that is you don't have to lock up all of your time to figure out what you need to do, because markets, they go at a pretty frantic pace. So if you wanted to try and keep yourself up to date with all the different rules and regulations and all the different industries and what to buy, what to sell, you know, you're going to lock up so much of your time that you might be less effective in your personal life as a
And we will
spouse
put
or as a
the
parent,
contact
and then
information
as an
for Eddie
owner,
and
operator,
myself down
manager
below.
type, where you might
Thanks,
not,
everyone.
you might
Thanks.
be missing
Appreciate
small
it.
details or not managing your personnel effectively. So, you know, this other commodity that we haven't discussed about having all of your time back is another benefit, that you have your plan, you know it's in place, you trust the people around you. Now all your focus gets to be where you can add the most value in your personal life and in your professional role. So we're not just doing it for this, you know, for what we can measure on a spreadsheet, but we're also really trying to allow you to unlock all the value that you can.
Yeah, because it all comes down to time. It comes down to your personal time. That's what this whole thing is about. That's all.
Absolutely.
So if the good folks out there are listening to this and they're asking themselves, how do I start planning? Where do I go? Who do I speak to? Where would you recommend, and how do folks get a hold of you?
Sure. Well, the first thing, the first step is acknowledging that it may be helpful to do so, and then, you know, going into the conversation with an open mind is a great start. So if you've done that, you know you're on the right track. I would obviously be partial to saying to come and check us out. You know, I'm sure we're going to leave our email addresses at the bottom and phone numbers, and you won't feel like there's any obligation. We do this all the time. We have consultations with people, we take phone calls with people, we give a lot of this advice away for free because we don't view it as this zero sum game. If we're talking to someone who's developing private wealth through private enterprise, we want that person to succeed. If we can help that person succeed, it's going to create jobs, it's going to create value, it's going to be better. You know, the products and services they're bringing to the market are obviously going to be seen as valuable to the marketplace, and we want that. And if that happens, then in the long run, you know, it'll karma, or, you know, the numbers will come back around in our favor one way or another. So you could reach out to someone like me as an example, and we could spend a few hours going over what to do. And if ultimately we don't want to work together, if it's not a good fit, or if I might be able to point you in the direction of another family office or another financial firm, you know, by all means. But the biggest thing is get started. You know, have a couple of 30-minute conversations, see who you like to work with, see who you have a good connection with, and really just go from there. And the big theme again is don't wait to do it. Don't have this liquidity event or this crisis where you think, well, who is that Geoff guy? I better call him.
Right.
You know, put it on the calendar now. You know, we could chat by the end of the week.
Awesome. Well, appreciate the time. It's wonderful having you. And for those of you out there, please like, comment, subscribe, follow along, because we will be doing more information like this. Geoff, thanks.
Thank you, Tim.